From New York City, for our viewers worldwide, I'm Matt Miller. As Nvidia bounces back, so too the market rises. The countdown to the open starts right now. Coming up, futures pointing higher as Nvidia bounces back from its three-day sell-off. Michelle Bowman warning that the Fed still sees upside risks to inflation. And Bloomberg Invest kicks off in New York City. We'll bring you conversations from the leaders in asset management, banking, and wealth. But we start with the big issue. Shares of Nvidia helping to push the market higher yet again.
The market makes perfect sense. It's paying up for quality, and it's paying up for growth that is, idiosyncratic from the economy and maybe some defensive properties. Okay, great. So I think the market totally makes sense. The question is, are those multiples now in those particular stocks too high? I think if you get a perfect, soft landing on this plane, it could be fine. If you don't, if you get any aberration from that, it's going to be a problem.
Joining us now is Brent Schutte, CIO at Northwestern Mutual Wealth Management. Brent, great to have you on the program. Today, we saw Nvidia wipe $430 billion in market cap away in the last three sessions. We expected to bounce back at the open today. What's your take on what some people have been calling the most important stock in the world?
Well, I think it just shows to what Mike Wilson said, how dependent the stock market is on a few stocks. And so I believe the top 10 names in the S&P 500 now make up around 38% of that index. And to me, that's risky. I know that's where the earnings growth has been because the economy has been weak. To me, I think you need to think about the next 1, 3, 5 years where you want to focus more on valuations. And I think that's where you see opportunities in things like small and mid caps, where there is already a recession priced in. The S&P 600 trades at an 8 times price to cash flow, which is usually reserved for coming out of recession. And so that's where I think, ironically, the opportunities are in the future, even though I think there's still likely to be a recession. I just think some of those names have gone too far too fast, and that's where I think there are risks in the future. The question is, how much do you pay for those stocks? And I think that's still up for debate.
Hang on. So you see the big tech stocks, the Magnificent Seven, they've run too far too fast, and you expect them to come down as we get a recession?
I do. I think that's already where there's priced to perfection already. I mean, they're priced for economic insensitivity, which I'm not so sure there actually is. To me, it reminds me a lot of the late 1990s, where a few stocks drove the market higher. I think these stocks have been bid up because that's where the only earnings growth has been, and that's where investors have paid up for that. I think you need to think about the other side of this, which could be a recession, or it could be an economy that broadens back out, which I think that means the earnings picture broadens back out. And I think that favors things that are cheaper in valuation, which every time I hear a strategist say valuations don't matter, that to me reminds me of late in an economic cycle where people are trying to justify their bullish outlook. And that's where I think valuations actually matter the most.
In terms of those big stocks, though, Brent, a lot of people, a couple of years ago when the market came down at the beginning of 2022, were saying these are defensive stocks now, not just growth stocks. You don't buy that argument?
Perhaps. I mean, I think you've seen them perform that way. I mean, you always have to tell me what's next, not what is right now. And that's where I think people have positioned more defensively over the past year because we've been talking about a recession for some time. And that's where I think, ironically, if you actually get that, that may be the sign to be on the opposite side of that trade. Or if, on the other hand, you don't get a recession, you get more of a soft landing, that's where I think you have optionality, because I think the economy would have to broaden back out and the market would have to broaden back out, where 7 names aren't just driving it higher. It would be driven higher by a healthier economy that has more participation, also in markets, because earnings would broaden back out.
All right, Brent, sit tight. I want to dig into the economy right now with Michael McKee. We got some data out in the last few minutes, and Mike is Bloomberg's chief economics and policy correspondent. So, Mike, what have we got, and what is it showing us about the economy?
Well, housing's become a more important issue in recent months because people aren't buying, and that's not a good sign for that sector and for the overall economy. Latest house price indexes are out from the Federal Housing Finance Administration and S&P CoreLogic, Case-Shiller, long name there, and they basically show a slowdown, but still a fairly strong price increase over the last year. FHFA up 0.2% on the month and 6.3% over the year. Same thing for the S&P CoreLogic Case-Shiller, up 6.3%. Both of those down from the prior month, but still fairly elevated increase. And you can see even as mortgage rates start to fall, now these are delayed 1 month, this is April data, we're not seeing a real change in overall home prices. Now, the number of cities that S&P looks at, the 20 city number, comes in a little bit lower than we had seen for the year over year, 7.2%, as these others did. But the cities that are experiencing the biggest price increases include Boston and San Francisco, over 2% each still on a month-over-month basis. So we're still seeing some increases there. And if you want to look at, Matt, what the problem is overall for the housing industry, it's that we are seeing home prices contribute to inflation. And that leads us to a conundrum, because the Fed is going to maybe lower interest rates, but right now they're not. And you can see what's happened here is we had a problem, of course, during the pandemic of everybody buying houses, and that pushed prices up. But now we're seeing prices come down somewhat, but not enough, because the Fed keeps interest rates higher. And the fact that prices don't come down means inflation is higher, and the Fed needs to keep interest rates higher. So it's a sort of circular conundrum. And that was recognized last night by a couple of Fed officials. We heard from Michelle Bowman. She has been the hawk on the Fed, and she remains so, saying we're not still yet at the point where it is appropriate to lower the policy rate. She worries about home prices and the possibility that we're also going to see other inflationary pressures flare up. And Mary Daly worrying about unemployment, talking about future labor market slowing could translate into higher unemployment. So inflation's not the only risk we have. So at this point, something different from those Fed officials, but it just all feeds back into the what do they do? We don't know yet.
All right, Mike, thanks very much. Mike McKee there, Chief Policy and Economics Correspondent, talking to us about the latest data points and what we're hearing from Fed officials. Brent Schutte is still with us of Northwestern Mutual Wealth Management. Brent, so you're saying you see a recession ahead, or you could see a soft landing and a broadening out. Which data pushes you in either direction?
I think you're trying to transition an economy that was built upon low rates and lower for longer with regards to interest rates and inflation that people had as their mantra, and businesses operated that way, as did households, to one that's in higher rates. And I think that transition is going to be bumpy and still ugly. I think there's likely to be a recession, because I don't believe inflation is sustainably back to 2%. And I believe the Fed needs to keep rates higher for longer, which eventually will tip the economy into a recession. And I think that's evident in their comments. To me, wages are the final frontier, and that's where I think they're still above where the Fed thinks inflation is sustainably at 2%. And I think that was in Bowman's comments. And so to me, of all these oddities like the housing market, the price is rising. I just don't think inflation is under control yet. And I think the Fed's going to err on staying around too long, because they want to put that genie back in the bottle. And I think that eventually causes a mild recession, because the unemployment rate has to rise.
What do you think about the labor picture? Because Bowman was saying, if we get more restriction in terms of immigration, that will curtail what has been, a healthy supply on the labor front. And then we could see, the market tighten up a little bit again.
100%. That's where I think, if I'm going to be wrong, it has to be because more people come back to provide labor. The pool of labor increases, or AI is truly a huge productivity enhancement. And this kind of reminds me of the late 1990s, where you had economic cycle overtime, because you did have the internet, you had Y2K investment, and you had 25 to 54-year-olds stream back into the labor market. That's where I think the easy lifting has been done. I do think AI is for real, but I don't think it's in the here and now. And that's where I think wages are going to stay elevated, which keeps the backdrop for inflation sticky. And I think the Fed found out that if they actually try to cut rates, or optimistically speak about that, like they did back in October or November, the market rallies, the economy recovers, and guess what goes with it? Inflation. And so to me, that's where I think they're going to stick around longer. just because they want to make sure they're not acting as if it's 1966, which led to 67 to 82. And I think that means that you're eventually going to have a period of time where the unemployment rate rises to kind of increase that labor supply, unfortunately, in that manner, which I think will eventually cause call a recession.
I'm interested to get your take on AI, Brent. You mentioned it there. You're a CFA and a CFP, and but most importantly, you got your MBA from the Booth School in Chicago, so you're a numbers guy. That's why I think it's interesting to hear what you think about this, emerging technology. Some people are calling it a revolution. What do you think?
I think it is, actually. If you think about the internet, it was also. It doesn't mean the stocks that were doing well in 1999 were the ones that drove it all the way throughout. And it actually probably benefited the economy and other sectors of the economy as you pushed into the 2000s. And so that's where I think the future is still optimistic. I think it's still bright. I think there's enhancements on the way. I think productivity is something that we have to have in this economy, in this country, because we are aging. But I just think in the here and now, I think right now, I think you want to just be aware of risks that are out there. I think anybody who manages money for individuals needs to remember that they also manage risk, not just chasing returns. And that's where I think the next few months, unfortunately, are going to be bumpy and volatile. And I think investors need to be aware of that and need to be ready for the reality that stocks don't always just go straight up, and they do have downsides sometimes. And that's where I think things like bonds, things like thinking about the other side, and thinking longer term are more important than what's going to happen in the next few months.
So if we do have a Fed that drives a recession here, Brent, why do you want to be in small and mid-cap stocks? Why do you want to look for value if the economy goes into a downturn?
Because I think those things are priced already for that downturn. Perversely enough, in the 1990s, the backdrop was very similar. And actually into that downturn and into the recession, small caps value actually provided less downside than their other names, which were priced more for perfection. That's where valuation starts to matter. And then I do think it'll be mild, and economic headwinds right now for those segments turn into tailwinds. And I don't think anybody can perfectly time when that magic point is, or when which people start thinking about valuation more and coming on your show and talking about that. And that's why I think you want to at least maintain your position there and think about adding over the next few months as volatility increases.
Are there industry groups, Brent, that you think are safer? I mean, is it just the, traditional defensive sectors? And are there regions that you like, or is the U.S. still kind of the only game in town?
I don't know that the U.S. is the only game in town longer term. I think you have to think about international stocks longer term. And I know people have talked about this for a while, and I think investors get tired of hearing it, but it's reality. I think the one thing that investors need to think about going forward on the other side of this is the currency returns that they're likely to get, because the euro, the yen, things like that are incredibly cheap on a longer term basis relative to the dollar. And eventually, I think investors need to realize that currency, if those currencies do appreciate versus the dollar in the future, become a return enhancer. And so I think you want to maintain your exposure there. And so I think there are opportunities there, even though there are risks there, just like they are here. And I think being diversified is still the way that you deal with uncertainty, not being concentrated. And so to me, I do like those segments of the U.S. market. I like international stocks. And I just think it seems highly contrarian right now. But I think, a few months from now, I think you're going to be hearing more about that type of investing, which I think is more important. It's focused more on valuation, not just themes and dreams of growth in the future.
Oh, we always love a contrarian take, especially if it's from a conservative mouth. Brent, thanks so much for joining us. Brent Schutte there of Northwestern Mutual Wealth Management. Joining us now to talk about some of the stocks moving ahead of the opening bell this morning. Some of the individual names is Abigail Doolittle. Abby, what are you looking at?
Well, Matt, let's start out with the shares of Nvidia. We're just talking about that bounce back rally. We do have the stock up more than 2% after sliding more than 10% in 3 days. So a fast correction. But we've seen this story before this year, from the March peak to the April low. Basically in a bear market, then the big move higher. Net right now on the year up more than 140%. As for some of the stocks that are dragging on the overall indexes, let's take a look at the shares of Boeing. They're falling in sympathy with Airbus cutting their earnings view and planes to be delivered on supply chain issues. Connected to Boeing, we have Spirit Aero Systems down 3.6%. Boeing is, of course, to buy a part of that business valued at $35 per share, but now they're talking about it largely being a stock transaction as opposed to an all-cash transaction. Investors apparently not liking that. And then Carnival sliding ahead of earnings, which should be coming out any moment. Bookings are actually expected to be strong. I'm just taking a quick look to see if that release has come out. It has not, but it should soon, and we'll be talking about that on the open, Matt.
Absolutely. We will talk about that. That deal is very interesting. Switch from a cash deal to a stock deal. And obviously, we're watching the aerospace area very closely. Abigail's going to come back in just a minute. We're going to talk about a pool stock. Have you put in a pool already? Are you planning to, or is money tight right now? Also, shares are taking a belly flop after the company slashed its forecast after the bell. So we're going to take a deep dive. Oh, so many puns. This is Bloomberg. The momentum is draining at Pool Corp. The stock is slumping after the pool supplies distributor slashed its full-year earnings forecast. The company warning of a more cautious consumer. Joining us with more is Bloomberg's Abigail Doolittle. Abby, I was thinking about this story when I heard the headlines yesterday. So is the idea fewer people are installing new pools? They're just not buying gear for the pools they have? What are they saying?
They're not installing new pools. And what makes this so interesting, so they've slashed the profit view for the full year by as much as 22%. Making that super interesting, though, is just 2 months ago, they were saying demand was going to be normal. Now they're saying seasonal demand is weak. And they're also talking about the idea that pool permits, they're down, but that new construction activity, that's a piece of it. That remodeling activity on the year is expected to be down 15%. So you put all of this together, and it seems as though there's a little bit of an air pocket in terms of consumer demand. Now, the question is that people really struggling? And of course, these are going to be higher end consumers who can afford a pool. Or you made this point earlier when we were speaking, does everybody who wants a pool already have a pool?
Right, because the high-end consumer, we're not supposed to be worried about the high-end consumer, right? It's the bottom 2 quintiles that are apparently struggling the most. But if you want to put in a pool, it's going to cost you more like hundreds of thousands than tens of thousands of dollars.
Yes.
Those people should have the money, but maybe they already put in their pools.
Maybe they put in their pool, but they're talking about the housing starts for May being weak and that's a piece of it. And I actually looked up the average price of a pool. It was shockingly low based on what we were talking about earlier. It's $35,000. So it's those super high
Really?
end. Yes. So it's much cheaper than you would expect. I think then when you throw
I don't know that they have Westchester labor costs built into that.
Yeah, no,
because
this
I
is
can't
probably not in
imagine
New
doing
York.
it for 35. Like if you want to put a pool in Greenwich.
Yeah, 35 grand is not going to do it, but it's going to be a 6-figure. But let's bring Winnebago into the picture, because Winnebago not so long ago, they missed estimates, they cut their forecast, and they were talking about a demand issue also. They're also blaming the Fed. They're saying that because the Fed has taken so long in terms of cutting, that's thrown off consumer sentiment, and people are just not spending money on those Winnebagos.
And I know the prices on those are high.
They
I've
are
looked
high.
at Winnebagos, at Airstream, RVs. You're talking about 6-figure purchases here, 200,000-300,000. The problem there is a loan to buy one of those is going to be like 10% right now.
Yeah, I mean, that's almost like buying another house, and that's like buying the price of a house that an average consumer might look at. One thing I would say though here is this just people who have a lot of money pulling back, or is there something more significant? Because to your point, it is the bottom part of the economy, the bigger part of the economy that we're going to care about more generally. But if the sentiment at the super high end is off, and we think about Walmart recently saying, that you
high-end consumers are pulling back. They're not going to maybe Whole Foods as much, but they're trying to save money at Walmart.
It seems as though maybe that they are picking up on signs of something out there in the economy that they're thinking about. I don't want to say hunkering down, but they're being a little bit more careful. And actually, Samantha LeDuc of LeDuc Trading is going to be joining Vonnie Quinn and I later today. And she's talking about the idea that you can already see that global credit is contracting. And when that happens, that is an early sign that economies could have a tough time. And at some point, the stock market, not in the immediate zone, but points of concern.
What time should people tune in for that conversation?
12:30 p.m. Eastern.
12:30 p.m. All right, I'll be watching that, because the pivotal question is, is demand drying up now, or was demand just pulled forward by the pandemic? And that's a debate that. But
maybe a little bit of both.
But the shares are acting as if demand has dried up.
Yeah, down 10%. And Winnebago's down about 25% from its last peak after that earnings miss and the guide down. So I think that there are signals. I mean, I think, and also if we bring in some of the luxury companies into the picture, I think that there are some signs that there's a little bit of softness for the high-end consumer at this point.
Yeah, consumer discretionary, the second worst performer on the S&P in terms of the industry groups.
Really?
Yeah, it's actually down.
I wouldn't have guessed that.
Year to date. All right, Abigail Doolittle, thanks very much for joining us. Day one of the Bloomberg Invest Conference is taking place today in the heart of New York's financial district. Man Group CEO Robin Grew is currently on stage with Bloomberg's Romaine Bostick. Let's listen in.
So my experience through navigating those things have been incredibly valuable. I think the other piece is I have run large chunks of Man Group, be it trading or be it ESG or be it our solutions business. And that evolution has been very, very useful. So I have the benefit of seeing the organization and financial services through many different lenses, and that has stood me in very good stead.
You talk a lot about how the technology has increased productivity.
Yes.
When we talk about the new applications of AI, and I'm not just talking about the front-facing chatbots that we all know about, but really
all right, that is Robin Grew, the CEO at Man Group, speaking with Romaine Bostick at Bloomberg Invest in New York. You can continue to follow that conversation or watch, all day long. If you've got a Bloomberg terminal, just type LIVE GO, live go, into your terminal. Coming up, we're going to give you the morning calls, and then later, Mona Mahajan of Edward Jones joins us. What she sees as the risks to a soft landing. Man, a lot of recession talk today. This is Bloomberg. We're looking at gains right now in futures. S&P futures up about 0.25% right now. NASDAQ futures up about 0.5%. This as Nvidia bounces back. That stock was down for 3 sessions in a row, and those drops wiped $430 billion off of Nvidia's market cap. It's now worth less than $3 trillion. Let's get to today's morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up is TD Cowen upgrading the gap to a buy. The firm says that the company is in the, quote, early innings of its transformation across all 4 brands, that the growth potential there is underappreciated. Next up, Wells Fargo is raising Capri Holdings to an overweight. The analyst sees potential rewards outweighing risks and says investors have lost sight of the value in the Capri portfolio due to concerns regarding whether Tapestry's acquisition of the company will proceed. And finally, Raymond James is downgrading Penn Entertainment to a market reform. The analyst says the company's path to profitability in digital continues to be uncertain, and that he doesn't expect any dramatic shift in strategy in the near term, so he doesn't want to buy Penn Gaming. Coming up, Mona Mahajan, Edward Jones Senior Investment Strategist, tells us where she sees opportunity in the market and where the risks are to the potential soft landing. This is Bloomberg. This is the countdown to the open. I'm Matt Miller. We are moments away from the start of trading. You can see that futures are higher on the S&P and the NASDAQ. Booz Allen set to ring the bell down at the New York Stock Exchange right now. Let's take a look at some of the other assets that we want to keep our eye on. Obviously, the euro right now is hot or down, I should say, as Allianz Global Investors warns EU officials they need to reinsure investors that finances are stable ahead of that snap French election. Voting starts in the first round on Sunday. You can see the 10-year yield right now at 4.25, and NYMEX crude coming down just a bit, but still well over $80 a barrel at 81.39. One of the stocks that we're watching, maybe the only stock you need to watch, is Nvidia, bouncing back after its 3-day drop. $430 billion wiped away. For more on that, we're joined by Bloomberg Technology co-host Ed Ludlow. Ed?
Yeah, so Nvidia's up more than 2% at the open, Matt. And I think it's a day where we look at the Bloomberg terminal and we get technical. You know, we entered a technical correction across those 3 sessions, a more than 10% decline. We're rebounding slightly from that, but a number of market participants would say, well, this is a stock that is trading significantly above its 50 and 100-day moving average. As you'll see in that key story on the Bloomberg terminal, $115 a share is identified as a key level of resistance. These are people that look to the charts for some justification after what was quite a serious rout. But I heard Abby talking earlier, right, about this idea that this was the first technical correction since April, when we went from that March peak to April low. But you also then have to come back to earnings. We had a 43% gain in the stock following earnings on May 22nd. And what the story has been is the street struggle to keep up with forecasting revenue growth. So what the guidance was for the fiscal second quarter of the financial year 2025 in the earnings print is $28 billion of revenue, plus or minus 2%. As we discussed yesterday, even the midpoint of the range that management have given us, Nvidia's pretty comfortably exceeded that in periods gone by. One note of caution, I spoke to an investor in Nvidia yesterday in Bloomberg Technology, Ayako Yashioka at Wealth Enhancement Group. She holds more than 7 million Nvidia shares. And she was explaining to me that when she came up in the market, she was always told, be cautious about a stock that has a price to sales ratio of 10 or above 10. This is a stock that has a price to sales ratio above 20. But she also acknowledges that Nvidia may be supply constrained. In other words, the thing we're so hyped about, its product, it could be selling more of it if TSMC, its main contract manufacturer, was able to provide it such. So it's a mixed picture, but it's a modest rebound, 2.5%.
Well, and you want to look at price to forecast sales, right, Ed? Because the stock market's a discounting mechanism. And who knows what the sales are going to be?
Yeah, I think the other big unknown is that the product-specific categories are now important. We've raved about the H100, which is its main AI accelerator at volume, but they're quickly ramping H200, the next generation. And as we heard in earnings, by the end of this calendar year, they will start shipping in some tangible volume Blackwell. And so we just don't know what the revenues from that new product line will be with NVIDIA's commitment to bring a new AI accelerator online each calendar year. That's where the street has trouble. But yes, you're right. Those numbers that I was giving, I'm talking about price to forecasted sales over the next 12 months.
Ed, thanks very much. Bloomberg's Ed Ludlow, co-host Bloomberg Technology. You can catch that program at 11 o'clock Eastern time. Now, Carnival Cruise is out with its latest results just a few minutes ago, and Abigail Doolittle joins us for more on this consumer discretionary stock.
Yes, indeed, Matt. So here's a bright spot, because we were talking about some of the weak spots for discretionary not moments ago, some of those big spends in terms of pools and Winnebagos. But relative to cruises, which you can do in a relatively price-attractive way, well, they put up a good quarter. They put up a profit of 10 cents versus the loss, 11 cents, excuse me, above the loss of 2 cents per share. The forecast looks strong. They've raised guidance. So not surprisingly, the stock is up 3.2%. That is a fifth up day in a row. What makes it so interesting, though, Matt, is that in the pre-market, the stock had been down more than 1%, even down more than 2%. So there were some jitters, but this company has delivered, at least right now, ahead of the call, off of the lows, I think about a year, 2 years ago, up now more than 170%, but still well below the pre-pandemic, so sort of right there in the middle. But it does seem as though that their business is rebounding for those who like to cruise.
All right, Abigail, thanks very much. Bloomberg's Abigail Doolittle talking about the cruise stocks, always interesting. Let's get, though, to aerospace. It's been a hot industry to talk about the last few days. Now, Spirit Aero is down. Boeing has switched its proposed funding for a bid from all cash to a stock, mostly stock deal. Bloomberg's global aviation leader, Benedikt Kamel, joins us now from Berlin. So I guess Spirit Aero shareholders want cash money and don't want shares.
Yeah, you're absolutely right, Matt. Cash is king in this case, and Spirit is a company that is really cash-strapped. But you know, the truth is, so is Boeing. We've seen this company in a real sense of crisis since the start of January. They lost about $4 billion in cash in the first quarter and have warned that the second quarter won't be any better. So this is a company that's losing more than $1 billion in cash a month. Yeah? So obviously this company has a lot of issues, and cash is something they will want to preserve. We're hearing that the deal might be close, but these sort of final backs and forths are putting a bit of a strain on the timing. We're hoping that maybe they'll be able to get it over the line this week. It's an incredibly complex deal to unpack because Spirit is the main supplier to Boeing, but they're also a big supplier to Airbus, which is obviously the arch rival of Boeing. So sort of piecing that apart, making sure that the bits of Spirit that provide stuff for Airbus land in the right camp and the other parts land in the Boeing camp. That's really complicated. So you've got the financial element, you've got the operational part, all of which sort of make up a slightly messy picture, which is why this deal is dragging out.
By the way, in terms of Airbus, Benny, when I was with you in Berlin 2 years ago, I talked to Guillaume Fauré, and he said at the time his suppliers just weren't ramping up their production of the parts he needed fast enough, and that was a huge constraint on sales. Now he's said that the problem is worse than he's expected.
Yeah, I mean, this is the thing, on the one hand, no surprise, because as you said, this is something they've spoken about for years. Coming out of the pandemic, probably even before the pandemic, supplies were always a big issue. This is not a demand story, it's a supply story. The suppliers do not have the manpower, they don't have the equipment, and that's really rippling through the line. So will it get any worse? They might try and stabilize some of the most vulnerable suppliers, as we're seeing with Spirit now, but there are others out there that they're taking a very close look at. They might need to inject some money there and additional manpower. But he has said, as recently as this month, he told us, this is a problem that will stay with us for another 2 to 3 years, so no real improvement on the horizon there.
Has Airbus, Benny, managed to really capitalize on the big Boeing problems, the nasty headlines, the 737 issues, the whistleblowers? Has Airbus actually taken customers from Boeing because of that?
Not in a tangible way. I mean, this is always what people might think. You've got these two players, so if one is down, the other one picks up business. But this is a really long-term operation. If you're an airline that's a loyal Boeing customer, you won't quickly switch. There's a lot invested in that relationship in terms of training, in terms of simulators, in terms of crews, in terms of maintenance. So you can't just go back and forth. And the other thing is, even if you wanted to go to Airbus, they just don't have the planes to sell. So, you could say, hey, we'd rather go from the 737 to the 320. Airbus will say, great, but join the end of the line because we're sold out until the end of the decade. So they've picked up a couple of sales here and there, but not in a big business, in a big way.
All right, Benny, thanks so much for joining us. Bloomberg's Benedikt Kamel there in Berlin runs our airlines, or our aircraft, I should say, coverage for us. And he's wearing an Ed Meyer tie, probably the best clothier in all of Germany, M-A-I-E-R, Ed Meyer. Check it out. All right, let's talk now to Mona Mahajan, Edward Jones Senior Investment Strategist, about the risks to a soft landing. Mona, I was talking with Brent Schutte earlier from Northwestern Mutual, and he was saying he expects a recession. Do you share the same bearish view of the economy?
Yeah, thanks, Matt. For us, a recession is not a base case. In fact, it's probably a tail risk, if anything. Our base case is the economy can cool, but cooling from a position of strength. So last year, we were looking at 3.4% annualized GDP on average every a quarter of 2023. This year, we're probably looking at closer to 2% or maybe sub 2%, but still in line with what we'd call trend growth levels. Now, clearly what we're seeing in the economy is a labor market that is starting to cool. We have a 4 handle on unemployment now. We are seeing early indicators like job openings that are cooling. The quits rate is coming down, so folks are not quitting their jobs at the rates they once were. And we're also seeing, the consumer is quite comfortable when they feel very comfortable with their jobs. So if the labor market is cooling, consumption may be cooling as well, but certainly not to a negative growth rate. But perhaps from a position of strength, some normalization is occurring.
I'll ask you an uncomfortable question, Mona, because Michelle Bowman said that restriction of immigration would curtail supply in the labor market. And that leads me to wonder, does the election make a difference? I mean, clearly, Biden has come out with some restrictive immigration policies, just ahead of the vote. But Trump would be, I think, more restrictive. Does it make a difference who wins in November?
Well, certainly policy and presidential policy has long and variable lags before it becomes meaningful in terms of what we're seeing in real time. And so we'd say is real policy change takes time. Meanwhile, what the markets have demonstrated to us, and when we look back at history, we really see, regardless of who's in the White House, what tends to drive markets more broadly, and even to your point, the labor economy, tends to be things like what is happening with inflation, what is happening with the Fed funds rate, what is happening with earnings growth. And so those factors we think are lining up nicely still ahead of that November period and even in the years following. Also, what we see is, in a 4-year presidential cycle, historically, year 3 has been the strongest. That was last year. But year 4 tends to be second strongest. And part of that is uncertainty is unlifted. Part of that is the administration is putting policies in place that might help voters at the voting booth in November. But more broadly, we'd say don't play politics with your portfolios. Think about long-term impacts from the fundamentals more so than any real policy changes.
But it must be tempting, I mean, especially for an equity investor, Mona, who's already racked up gains of 14% year to date, to say, you know what, I'm going to just sell now, take my profits before we even get close to November, and, maybe I'll get back in after. What do you think about that? Especially as the consumer, shows some signs of weakening.
Yeah, look, you make a good point in that volatility does tend to be elevated in the 6 months prior to the presidential election day, November 5th this year. And even in the weeks ahead of presidential election day, markets do tend to show some pullback. But what's been pretty consistent is the 6 to 10 weeks after presidential day, markets tend to recover. And so what we were really thinking about is if you do get that period of volatility, and we haven't gotten much volatility this year thus far, so maybe that period ahead of election day will bring some. That's really your opportunity, especially if you haven't participated much in this 14% rally, to your point, 24% last year in the S&P 500. It is a great opportunity, we think, to position yourself, whether it's rebalancing, whether it's diversifying, whether it's adding quality investments at better prices. Think about that balance between growth and value, growth and cyclical parts of the market. We saw even in the last few weeks as Nvidia, the mega cap giant, AI giant, pulled back, the rest of the market actually held in there. And so the early signs of that broadening of market leadership starting to play out. We would use periods of volatility to our advantage. We want to be positioned for not only this year, but really the years ahead, where we do think the bull market phase has some legs ahead of us.
Wouldn't you? I mean, I don't want to talk about an individual name with you, Mona, but in terms of AI, right? If you see a decent AI sell-off, wouldn't you view that as an opportunity to buy in?
Certainly, we do think AI is in the early innings of what is a multi-year secular growth story. We think right now the enablers of AI, so the infrastructure players, the semiconductors, et cetera, the building blocks of AI are seeing most of the gains. Over time, we would expect that to broaden a bit. So the sectors that would benefit from the efficiencies of AI, think about healthcare, think about infrastructure and robotics and manufacturing, or even financial services. All of these sectors we think will benefit from the efficiencies. We should see it show up in the gains as well. But to your point, if we get a pullback in AI and you don't have the exposure you want, that is a great opportunity to get into long-term, what we think is a theme that will have some legs ahead of it.
What about smaller cap stocks, mid cap stocks? I guess undervalued, or what a lot of people would view as undervalued stocks. Mona, you talk about rebalancing. Is that where you'd go?
Certainly, we are still favorable on large cap and mid cap stocks here. Small cap space is interesting. Keep in mind, they have been weighed down because they're highly leveraged. They tend to have a lot more floating rate debt. And so in this high rate environment, they have not benefited at all from rates remaining longer for a more extended period of time. That may reverse a bit as we get closer to Fed rate cutting cycle. But where we like to play is in that mid cap space, where not only will they also benefit from a rate cutting cycle, but they have more profitable companies overall, a little bit better margin of safety in terms of exposure to economic upturn, and a more cyclical tilt as well. So we think mid caps are really an interesting way to play a potential recovery and a potential Fed rate cutting cycle ahead. We continue to like large caps here, both on the growth and value side as well. But I think there are opportunities in both those spaces if we do see pullbacks or even volatility ahead.
All right, love to get your take, Mona. Thanks so much for joining us. Mona Mahajan is Senior Investment Strategist at Edward Jones. Coming up, Paul Singer is pitching Wall Street its own way to make America great again, and it's starting to gain real momentum. We'll talk about that next. This is Bloomberg. It is less than 5 months until the U.S. presidential election, and this Thursday already, President Joe Biden and former President Donald Trump will be holding their first debate. The smart money on Wall Street is already pitching its own vision for Trump's America. Business figures led by hedge fund billionaire Paul Singer have poured nearly $200 million into a New York-based think tank to wage war on wokeness. Joining us is Bloomberg's Simone Foxman, who co-wrote this story. So, not a huge surprise that Wall Street isn't a huge fan of wokeness, but now they're really putting money behind that issue.
Yeah, this think tank is one that's been around for quite a while. It's called the Manhattan Institute, but under Paul Singer, who became chairman in 2008, and more recently under the stewardship of President Mahajan Salam, it's gotten a lot more influence. And they've really focused on this idea of wokeness, color blindness, anti-racialism, and that has really come about in things like anti-DEI, proposals about how gender is going to be treated in schools, but also advocating for the elimination of subsidies for EVs, solar and wind power.
Gender in schools? You mean gender affirmation in schools, right? Which is a slightly different issue.
How gender is going to be treated in schools. And they've come up with a lot of model legislation. And what they do is they send it out to lawmakers, especially Republican lawmakers, and especially on DEI, but it's getting attention on other subjects too. Sometimes these lawmakers are passing these rules literally word for word, citing this model legislation. In fact, Manhattan Institute claims that 11 states have passed its anti-DEI legislation in terms of universities. And so that kind of speaks to the amount of influence it's having, and it's trying to use this influence to gain some leverage in a Trump administration.
But they've also been kind of activated, triggered, if you will, by the rise in anti-Semitism that we've seen, right?
Absolutely. That is a key piece of it. And what they say, and they're among several voices here, is the idea that DEI on campus and this communist-inspired ideology, left-wing ideology on campus, has really turned into anti-Semitism on campus. Now, that's not an opinion everybody shares, certainly.
You don't think that that's a fact, that you've seen a rise in anti-Semitism on campuses?
Well, certainly there's been a rise in anti-Semitism on campus, but not everyone believes that pro-Palestinian protests are anti-Semitic. They tend to believe they are. There are others who sort of take a different view on that and say, no, they're just campaigning for the rights of Palestinians. That said, certainly that what's happened on campus in the last year has played into some of the interest in the Manhattan Institute. They had a record fundraising at their most recent gala, $4.6 million in one night alone. And that, of course, contributing to that overall about close to $200 million that the Institute has raised for furtherance of its ideas in the last decade.
Well, the story is really well done. I recommend that everyone with a Bloomberg check it out. And indeed, even if you don't have a Bloomberg, you can see it on Bloomberg.com or in Business Week.
Not in Business Week.
Well, it should be in Business Week, Simone.
All over the internet, so
all right,
please read it.
Simone Foxman there, co-writer of the story. Highly recommend you check that out. Let's get back to the market now. Shares of Walmart falling this morning. For more, we bring in Bloomberg's Abigail Doolittle.
Yeah, a bit of breaking news here, Matt. We do have Walmart down more than 2%, heading to its worst day of the year since November of 2023. And behind this, headlines out of a Bank of America London investor conference, with the CEO essentially saying that this current quarter is not going to be as robust as the last quarter. If you remember the first quarter that they reported, it was really pretty tremendous. But the CEO saying that this current quarter, that they believe that this is the most challenged comp quarter of the year. So it's interesting. We were talking about Walmart earlier in terms of the support from higher end shoppers. Perhaps that's waning. But the CEO also saying that that first quarter, that strength, they think that's a vision of how it could potentially be in another quarter. But again, not just this quarter. Again, the stock down 2%, the worst day of the year. As for some sectors on the day, we're looking at the possibility of a gain for the S&P 500, right now up about 0.2%. Interestingly, though, Matt, most sectors are lower. In fact, 8 sectors down. Materials, real estate, industrials, the worst, all down about 0.5%. To the upside, though, and it's very interesting, Matt, to see that a 0.9% gain for the tech sector, that it's not leading the overall index up more, but that is the case. And you were talking about discretionary being the second to worst quarter or sector on the year. Well, that is the case. So lots of consumer sentiment in the spotlight today.
Yeah, very interesting. how investors are viewing the consumer and how they're playing that in terms of the stocks. Abigail, thanks very much for that. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg. Time now for the trading diary. What you need to be watching today and next week. We get June consumer confidence data at the top of the hour, and the Bloomberg Invest Conference is now underway. Definitely check out Live Go on your terminal to follow that. Tomorrow we get May new home sales. Thursday brings the first debate between President Joe Biden and former President Donald Trump. And we round out the week with PCE, the Fed's preferred inflation gauge, on Friday. This was the Countdown to the Open. I'm Matt Miller.